Welcome back to the deep dive. Today, we are taking a deep, unblinking look, you could say, at the financial machinery behind a huge global player in eyewear, Lenskart Solutions Private Limited.
That's right. We've been digging into their annual report for the financial year ending March 31st, 2025. And this isn't just any report. It really lays out the results of this massive, ambitious global expansion they've been working on.
And the headline number is, well, it's pretty shocking, a huge financial turnaround. So our mission today is to cut through all the numbers and figure out, is this pivot driven by just, selling more glasses? Or is it more about smart, maybe even aggressive accounting and consolidation? We want those aha moments hiding in the tables.
Exactly. We need to really separate what the parent company did on its own versus the performance of this huge group they put together worldwide.
Okay, let's get into it. Starting with that headline financial shift. It really is eye-popping.
It is, especially when you look at the big picture, the consolidated financials. That includes all the subsidiaries, everywhere. For FY 2024-25, the group reported a consolidated profit of INR 2,973.4 million. Let's just call that nearly 3 billion rupees profit.
Wow, nearly 3 billion in profit. But knowing their history, Lenskart's always been in this heavy investment mode, right? Often leading to group-level losses. How does that profit compare to before?
Well, that's exactly why it's such a big deal. It's a complete dramatic reversal from the previous year, FY 2023-24. Back then, they reported a consolidated loss of INR 101.54 million. So we're talking about a swing of over 3 billion rupees straight into the green.
Hang on, a 3 billion rupee swing. That's not just selling a few more frames. That feels structural, doesn't it? Is this some kind of magic or just really clever accounting? What's actually driving that massive change?
The heavy lifting, it's really coming from the consolidation.
Yeah.
If you just look at the parent company, the standalone performance, yeah, it was strong. Profit grew nicely from about 1.44 billion rupees up to 1.88 billion. Healthy growth. But that massive swing, the one turning a loss into a 3 billion rupee profit, that comes from bringing in the global subsidiaries onto the books.
Ah, okay. So the story isn't just we sold more in India. It's really about the math of their global acquisition strategy finally hitting the consolidated financials, letting them count a major new asset's full performance.
Precisely. And that big asset is Owndays, which, yeah, we'll definitely get into. But, it's important to note the underlying business looks healthy, too. Consolidated revenue jumped significantly from around 54 billion rupees to over 66 billion. And basic earnings per share swung dramatically from a loss of 0.11 to a profit of 1.77. So it does show the core strategy is working.
And the company itself says this growth comes down to two main things. One, pushing hard on increasing the franchise footprint. I mean, they seem to be everywhere now. And two, creating brand awareness with aggressive media campaigns. It's a pretty classic scaling story, really, both here and abroad.
Yeah, that franchise model is super effective for scaling fast without needing tons of capital for physical stores. It's kind of the operational engine behind this financial shift.
Right. Speaking of that engine, let's look at how they actually built this huge structure. This turnaround needed some very specific strategic buys, didn't it? Both at home and overseas. Domestically, they snapped up Lenskart Online Services Private Limited, DOSPL, making it fully owned this year.
And Lenskart gave them an immediate boost domestically. It was profitable right away. Reported revenue over 13.4 billion rupees and a profit of about 86 million for the year. Solid move to cement their Indian market position.
Okay, but here's where it gets really interesting and where we see the true source of that multi-billion rupee profit swing, right? The international play, focused on that Japanese eyewear giant, Owndays.
The Owndays consolidation, that's the absolute key. Their Singapore subsidiary, Lenskart Solutions Pardon Ltd., upped its stake in Owndays Japan by another 4.44% during the year. Seems small, but that nudge pushed their total ownership to 96.67% by the end of March 2025.
And that 96.67%, that's the magic number, isn't it? Once you cross that consolidation threshold, suddenly Owndays isn't just an investment on paper. You get to count, 100% of its performance as part of the Lenskart group in your reports. It's sort of like buying Boardwalk and Park Place and Monopoly, and suddenly all those global hotels are yours.
Oh, that's a pretty good analogy, actually. Yeah, it brought the whole Owndays network onto their books, a huge operation across Asia-Pacific. Subsidiaries in Taiwan, Malaysia, even Australia, where they own 56% of Owndays down under. It just shows they're fully committed to dominating the global optical space.
But scaling up globally like this, it can't all be smooth sailing, surely. While the overall consolidated number looks great, profitable, if you peek at some of the individual subsidiaries, especially the newer ones, you see the real cost of breaking into new markets.
Oh, definitely. While they get to consolidate all that Ondi's revenue, they're also pouring money into new frontiers, and yeah, those investments are showing early losses. Look at Lenskart Arabia Limited in Saudi Arabia, KSA. They brought in revenue, about 337 million rupees, so there's activity, but they reported a hefty loss, nearly 500 million rupees for FY25.
Ouch. Sounds like maybe acceptable losses for planting a flag in a major market, but it also means that shiny consolidated profit figure is actually absorbing quite a bit of pain from these newer ventures.
It absolutely is. Even their main international hub, Lenskart Solutions Platus, limited in Singapore, was still in the red, reported a loss of about 9.8 million Singapore dollars. Now, the good news there is that loss was way down from the previous year's loss of over 17 million SGD. So losses are shrinking in some key spots, but the investment push is still fierce elsewhere.
Got it. So the strategy seems clear. Use the profit boost from the big own days consolidation to fund this aggressive, pretty expensive expansion into high potential new places like the Middle East, mostly through that franchise model. Okay, let's pivot a bit now. Away from just the stoles and frames into Section 3, where Lenskart is placing its bets on diversifying, on future tech. They're making some specific investments that really signal they want to be more than just a retailer.
Yeah, they're definitely planting flags in the tech world. We see investments in two different companies using something called compulsorily convertible preference shares, or CCPS.
Okay, quick timeout. CCPS. For listeners who maybe don't live and breathe financial disclosures, what's the simple version?
Think of CCPS basically as equity in waiting. They're preference shares, but they have to convert into regular equity shares later on, based on certain conditions or dates. So it gives Lenskart a guaranteed future ownership stake. They got 175 CCPS in Adloyd Technologies. Private Limited actually got those for advisory services they provided, and they invested directly to get 137 CCPS in We Hear Innovations, PVT.Ltd.
Right, and why these specific companies? What does that tell us about where Lenskart sees things going?
Well, Adloyd seems highly relevant, right? They do augmented reality and virtual reality. That's obviously key for things like virtual try-on, which is so central to Lenskart's online business.
Mm.
Weir, on the other hand, is focused on hearing tech and audio.
Hmm.
That hints pretty strongly at R&D into smart glasses, maybe integrated audio or other sort of futuristic optical products. They're basically hedging their bets on what eyewear might look like next.
That makes a lot of sense. They're not just selling glasses now, they're investing in that whole interface between tech and vision. But the most structured new venture seems to be this 50% stake in VisionSure Services Private Limited. That's classified as an associate or a joint venture.
Right, this JV. It was only set up in August 2024, so it's very early days. And the financials show that an early loss after tax of about 11.3 million rupees for the part of FY25, it existed. Totally expected for a startup phase.
But the real value here isn't the immediate cash, is it? It seems to be about future rights, looking at the contract terms. That's where the insight is.
Absolutely. The contract details, they're in Form AOC2. They show this structured future payout. It's designed to give Lenskart a claim on VisionSure's long-term revenue. VisionSure has to pay Lenskart a 2% royalty on its gross sales, but only after April 1st, 2028. Before then, Lenskart gets this sort of complex fee based on benefit value, which really just looks like a way to get their initial investment back first.
Huh. So that fee structure, it suggests they aren't banking on quick cash. They're locking down a piece of future IT revenue, right? A long-term royalty play. It means they benefit if VisionSure hits on some important tech without taking on all the risk right now.
Exactly. It's strategic future-proofing. Smart move.
Okay, let's shift gears again. Section 4, looking inside the company. Capital structure, corporate governance, stuff that gets really important when you're operating at this kind of global scale. First off, that huge change in share capital.
Yeah, a classic move for a company growing this fast. A massive bonus issue of common equity shares back in October 2024. They did it in a 1.9 ratio, issuing over 693 million new shares.
Wow, 1-for-9 bonus. That's a huge jump in the number of shares out there. Usually done to boost liquidity, make the stock maybe feel more accessible, possibly getting ready for future capital market activity.
That's likely the thinking, yeah. And on the employee side, they're clearly focused on keeping people. You see nearly 11 million stock options outstanding at year-end, and options exercised during the year brought in about 24.5 million rupees.
And they specifically mention grants to key people, like the CFO, Mr. Abhishek Gupta, got 350,000 ESOPs in August 2024. Standard practice, but important for keeping top management focused on long-term value.
Definitely. Then shifting to governance. The board looks pretty professional. They've got two independent directors, Mr. Jayesh Tulsidas Merchant and Mr. Bijoukurian. And the board met 7 times during the year. That's quite frequent, suggests they were keeping a very close eye on things during this big transition year.
And what seems really new and important in the governance structure is setting up that formal risk management committee during this past financial year.
Yeah, that's a critical sign they're maturing. I mean, when you expand globally like this and absorb a huge asset like Owndays, your risks just multiply: operational risk, currency risk, compliance risk. It all gets way more complex. So making it official, having a committee tasked with preparing a risk register at least twice a year, that shows they're building the kind of bureaucratic muscle needed for their global scale.
Right. And finally, just touching on compliance and social governance bits, they have a whistleblower policy, seems standard, no incidents reported this year.
And importantly, their internal complaints committee for handling sexual harassment cases.
Yeah.
It received 2 complaints during the year, and both were resolved. On the CSR side, corporate social responsibility, they hit their target exactly, spending 13 million rupees, mostly focused on preventive eye care and vision correction for underserved communities, done through the Lenskart Foundation.
Okay, so let's pull it all together. What does this all mean? The big profit swing, the aggressive global buy-up, the tech investments. What's the final picture?
It really feels like FY25 was the year Lenskart officially transformed. They went from being, a super successful Indian retailer with global dreams to being a proper, globally consolidated powerhouse, that big profit pivot. Mathematically, it was driven by pulling Owndays fully into the results. But the underlying growth engine is still that franchise model, plus these active bets on future tech like Adloyd and that VisionSure JV.
So it's a major transition year, captured right there in the financials. The numbers show they definitely achieved massive scale. But there's one last subtle detail that really highlights their strategic focus. Beyond just selling glasses, you have to look at where they spent foreign currency during the year.
Ah, yes, this is a really telling point, often gets missed if you break down where the money went overseas. Spending on technology absolutely dwarfs spending on marketing. Foreign currency spent on software was 250.8 million rupees.
Okay, 250 million on software. And just for comparison, how much did they spend on marketing abroad?
Get this, only 13.5 million rupees. The difference is just stark, isn't it? This suggests they aren't primarily acting like a consumer brand just trying to buy eyeballs overseas. First and foremost, they seem to be operating like a technology company. They're constantly investing in the software, the logistics, the platform needed to actually run and coordinate this incredibly complex operation across so many countries, currencies, regulations. That software spend, it tells the real story of their global machine.
It absolutely does. And that leaves us, and you, with a provocative thought to chew on. Given how much upfront investment these global subsidiaries clearly need, you see it in the losses in places like Lenskart Arabia and the new VisionSure JV, how long do you think it'll take for that overall consolidated operating income to truly stabilize, to really start capitalizing fully on this massive geographic footprint they built in FY25 before the next big wave of tech reinvestment might be needed? It's really a question of when all that scale translates into consistently strong operating margins. Something to keep an eye on when their next report comes out.